In this week's video, we'll examine the question, is a sharp reversal imminent in stocks? We'll review the bullish case, the bearish case, and we'll talk about trends and the use of hard data in indecisive markets. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll kick off this week's video with the monthly DeMark chart. DeMark charts and indicators are proprietary tools from Market Studies LLC. What is our objective here? Under our approach, our objective is not to forecast the future. Our objective is to use hard data that's in front of us to help us get on the right side of what could be a big move in stocks. We've been talking about the inflection point somewhere around 2075 on this monthly chart. It's possible if we break to the upside that we could move all the way to 2340 on the S&P 500, and it's within the realm of reason relative to how markets ebb and flow, that if we break to the downside, the S&P 500 could fall to 1680. One of the great things about developing your own proprietary model in-house is you understand what the model does well and you understand what it does not do particularly well. No model is perfect under all market conditions. How do we handle that? We handle that with the implementation rules. When the S&P 500 was up near the all-time high in the spring of 2015, the trends were strong and the hard data was favorable. However, we did not break out to the upside. We established a point of potential resistance. Here, same situation. Late in 2015, the hard data and the trends and the observable evidence are greatly improved at this level here relative to this level here. From a probability perspective, typically something good will happen here and typically something good will happen here. There are exceptions, long sideways consolidation periods. Therefore, when we come up to this point here, once again, the hard data is allowing us to buy here. That's not the question. It's the implementation rules that are trying to minimize the probability of whipsaws. So if you're a client and you look at what we own today, we always have to look at it from the perspective of the entire portfolio. What percentage of the portfolio is in cash? What percentage of the portfolio is in equities? What percentage of the portfolio is in bonds? What percentage of the portfolio is in hybrid assets that can do well in bull or bearish periods? It's the entire portfolio that we're looking at. The context here is when we're here, we look very similar to this point here. Here, we look better than we did here. This is a lower high. This is a lower high. Here, we don't have that. We have a lower high, and now we've made a higher high. What that tells us is the probability of a bullish breakout is greater here mathematically than it was here. However, we still need price to confirm that, and that's where the if-then rules come in. Therefore, if the stock market can break above potential resistance, then mathematically we can scale in at a much faster rate. Entering in rapidly here is not a particularly good risk-reward proposition. Notice all the white space that we have below. But the probability of a breakout here, again, is higher than it was here. And our recent additions on the growth side are simply reflecting the probability of a potential breakout. If the S&P 500 can move above potential resistance and print a new high, then the risk-reward from a probability perspective starts to improve dramatically because it's possible that you could make a move all the way above 2300. Therefore, the trends and the hard data are one of the things to consider here. The other big consideration is potential resistance and the fact that we're in a longer-term sideways consolidation period, which is not particularly unusual, and that's why the implementation rules are already in place to help us deal with that from a probability perspective. If we look at this weekly chart as of May 20th, this here really doesn't look that much different than this period in here that was followed by weakness. Therefore, at this point, the model is still trying to be patient to get the market to prove something to us. If we fast forward to the present day, you can see some evidence of improvement here. Here, we never go on to print a weekly higher high on a closing basis, nor were we able to clear this dotted line here. In this case, we've done both. It doesn't tell us that we're going to break out to the upside, but it does tell us that the probability of a bullish breakout is a little bit better here than it was here. And if we look at our entire portfolio, at once, the addition in terms of growth reflects that relatively small incremental improvement in that probability of a breakout. So the bearish case is basically one of ongoing consolidation and potential overhead resistance, and the fact that the market and price need to prove it to us. Can we provide other examples of hard data or measurables that are improved relative to this point here? We can. We can do that in the context of the bullish case, and we present the bullish case to help us keep that flexible and unbiased open mind. We're not presenting the bullish case to forecast a bullish breakout. It simply helps us understand the need to prepare for the potential for a bullish breakout. It's easy to understand the bearish case after a plunge like this, a plunge like this, and the fact that we're still within the context of a downward sloping trend channel. It's a little bit more difficult to visualize or respect the bullish case. As human beings, typically what we do with charts and data is we always extrapolate. So when we're down here in 2011, it's very, very hard to visualize or appreciate the fact that we could go from a look like this to a look like this. It's much, much easier to understand a market that looks like this and this turning into something like this. So we're at one of those inflection points now. It's incredibly important to understand that at an inflection point, we could go up or we could go down. Was there anything here that might have helped us understand or keep an open mind about possible improvement? And was there anything in this area here that would have helped us keep an open mind about possible improvement? The answer is a definitive yes. So what we're going to do next is we're going to take the chart that we've been looking at for some time, and we're going to zoom into this period here and zoom into this period here and add some indicators to the mix. To set the stage here, this is the same chart. This is 2006. We've just zoomed in, and this is 2009 here. If you were working on Wall Street or managing your own money or trading your own account in early 2009, you might have remembered that many people felt in here that the world was about to end. Was there anything on the charts that would have helped us keep an open mind about all outcomes, including a plunge in this direction or a reversal? The answer is yes. Divergences, big divergences in this case, because it's an extreme example, because this plunge here is extreme relative to the plunge that we just went through. However, the concepts still apply. A divergence, a price here, point to point, price is at the exact same place here in late 2008 as it was here in roughly mid-year 2009. Momentum here at this point is absolutely positively terrible. I've got a blue line drawn up to where price is. When we get back to the exact same place, momentum is much, much better. This is a bullish divergence here. price is flat, MACD histogram is much or greatly improved from point A to point B. The same thing can be said for the relative strength index, RSI. We could look at numerous momentum indicators at these lows and draw similar conclusions. Price here, RSI way down here, horizontal line prices in the same place. RSI looks much, much healthier here, telling us to keep an open mind about all outcomes. In this case, we plunged in this direction. When we're here, we don't know, based on this, that we're eventually going to go higher. All we know is these divergences are telling us to keep an open mind about all outcomes. And notice in this case, the market doesn't make it easy for anyone. When the divergence is in place here, the first thing the market does is move in the opposite direction. But eventually, a new bull market starts, and these divergences helped us keep that all-important, flexible, unbiased, and open mind. So let's fast forward to the 2011 example. Very, very similar situation. If you were trading your own account, managing your own investments, or working on Wall Street in October of 2011, you remember things did not look good. We had an early stage bear market profile with 200-day moving averages rolling over, 50 days dropping below 200 days. This looks like the early stage of a bear market, and then central banks got involved. However, was there anything that could help us keep an open mind after this bottom here? The answer is yes. When price comes up to this point here, this is where MACD is. MACD histogram is basically near the flat line when price is here. We drop, and then when we come back to the exact same level, MACD histogram is much, much higher than it was here. Price has gone sideways. Williams percent R, similar situation. Price, if I draw a line down here, this is where Williams percent R is, where my cursor is. When we get back to the same level, momentum, from an indicator perspective, looks much, much better. Do these divergences tell us that we're eventually going to move in this direction? No, they just help us keep an open mind about what may occur from here. Price eventually confirms these bullish divergences. We don't have to guess or forecast. They just help us with the open mind. Price confirms it, and then it gets much, much easier to move because in advance you've understood that these are in place and I better keep an open mind about better than expected outcomes. So let's fast forward to the present day. We have a very, very similar situation to 2011. We have the stock market plunging here, and we have the early stage look of a new bear market with 200-day moving averages rolling over, 50s dropping below 200 days, and price below both of those moving averages, which is our full bore bearish look. Similar concepts here. Price here in November of 2015 hits this point here. This is where MACD histogram was. I can draw a line down and hit it. We're back to the same level now, and MACD histogram has a bullish divergence similar conceptually to the divergences that were in place at the bottom in 2009 and after the reversal in 2011. Williams percent R, similar situation. It's here when we first visit this level. We're back at the same level a few weeks ago, and momentum is greatly improved. In this case, we went in the wrong direction after the divergence. But remember, something like that happened in one of our historical cases as well. This look here, all it doesn't tell us that we're going to break out in this direction. It just helps us keep an open mind about it, and it makes it much, much easier to be able to put the necessary contingency if-then plans in place to deal with better than expected outcomes. Remember last week we also talked about how this could be potentially an inverse head and shoulders pattern. Inverse head and shoulders are potential or probabilistic bottoming patterns that occur after a decline. So in this case, we have a sharp decline here in what looks like a potential head and shoulders pattern. It's also bullish when the right shoulder is a lot shallower than the left shoulder. Nothing has happened yet here either. We have not broken above the neckline. If we do break above the neckline, the longer we stay above it, the more relevant it becomes. The market on multiple time frames lately, the MO has been to get a breakout and then to have it fail. So we also have to be ready for something like that in this environment. One of the ways that we can tell if the model and the rules are helping us out is when we look at our entire portfolio, our entire allocation of growth assets, conservative assets, cash, and hybrid assets, and we look at the market's current profile and ask ourselves the question, are we sleeping well at night? If the answer is yes, that means we're probably in the right place. And if you look at our current portfolio, it allows us to migrate in either direction here. We can add to growth quickly if we need to in this direction. If the market moves in this direction, we still own defensive and hybrid assets, and that cash position that we have gives us that needed flexibility when you're near a potential inflection point. Confidence comes from having a game plan for all outcomes. Then you really can keep that all-important, flexible, unbiased, and open mind. You also know you're allocated properly or you're following your rules properly when you don't really know what outcome to root for. We're really not sure if we're rooting for a bullish breakout here or a bearish breakdown. What we're really rooting for is a sustainable trend. That's what we want to see. We don't particularly care if it's up or if it's down. We just like to see this sideways consolidation break down. And remember, in the past, we've shown in posts on short takes. In fact, you can Google this title here to find this post. It is not unusual when the Fed starts to raise interest rates or to shift policy that we see frustrating and indecisive markets. This is a sideways market that's incredibly frustrating. The longer we move sideways, the bigger the gain that we tend to get if we break out to the upside. The longer we move sideways, the bigger the gain that we tend to get if we break out to the upside. The longer we move sideways, the bigger the gain that we get. All of this speaks to discipline. This is the move that we want to get right, and we have to be able to withstand the frustration in here. Similar situation in 1994, pull out your hair type market, 1994, 1995. If you implement it properly, good things happened. It works both ways. This is a frustrating topping type pattern in here. The stock market is in the exact same place in 1999 as it is here in early 2001. The break can be to the downside as well. The longer we go sideways and the longer we're frustrated, the bigger the move that we tend to get. We don't know which way, and in this case, it was down. In terms of the charts that we've been covering in recent weeks, not much has changed here. This is the NYSE weekly. We're still in that indecisive area. This is the 50% retracement. This is the 61.8%. This is the weekly close. Daily NYSE, a mixed bag. Indecisiveness here, this looks pretty good. We're above all of these lines. The negative thing is, right now, we're printing a lower high. Open mind. Still floating right around the inflection point we've been watching for some time at 10,301. Even down at the 60-minute level, we were inside the box. We had a false breakdown here. This week, we may have had a false breakout above the downward sloping trend channel. Nothing is resolved on this time frame either. Mixed bag here as well as of the close on Friday, June 3rd. How is it a mixed bag? This move here looks quite a bit better than anything that happened here. This is a lower high relative to this high. This is a lower high relative to this high. Not the case here. However, we still have resistance, potential resistance above, and this about sums it up here. Look at the 200-day moving average. It's basically flat, as it was here. This is indecisive. We're indecisive on numerous time frames, and really price is the better guide in the short run. It's the weekly chart of the S&P 500 as of close on Friday, June 3rd. A couple of quick points. See these indecisive candlesticks here? A reversal followed. We have a similar indecisive doji look here. This is telling us that we basically closed where we opened. In fact, we opened the week at 2100 and changed and closed slightly below it at 2099 and change. This indecisive look doesn't mean we're going to go in this direction. It just tells us to be open to that. If we were to move in this direction, the indecisiveness could also mean a big move this way. Price has to confirm this look here. In this case, it did. Nothing particularly definitive either way on the VIX. We've poked our head below the blue line a couple of times, but we're still near the blue line, so nothing's resolved here yet either. Wilshire 5000 daily mixed bag as well. This move here, from a bullish perspective, looks better than anything we had over here. We also closed above the downward sloping trend channel here. However, we're still near the line. So with our recent series of failed breakouts, we need to see a little bit more here, but this is still a good reference point. S&P 500 weekly, Friday, May 20th. This has that indecisive, vulnerable look. If we fast forward to the present day, we see that observable improvement in the form of a higher high here. We're back to a full bore bullish look, but price was indecisive and flat. We have all types of reference points down here. This is a good bull bear demarcation area at 2050. A sustainable drop below 2050 would increase bearish odds. To keep an open mind, divergences are not limited to the U.S. Notice price is up in this area here. Look where RSI is. RSI is unable to recapture 50. When we're back up in the same area here, it's almost the opposite or the inverse or a mirror image. Look, we stay below 50 in this area here. Now we're staying above 50. It doesn't mean we're going to break out in this direction, but it tells us to keep an open mind and have a game plan in place for a move in this direction. We do have a game plan for a big move in this direction or a big move in this direction. The key to success here is consistent implementation during these incredibly frustrating periods. It's not particularly surprising that the stock market's been frustrating and difficult as the Fed is trying to shift policy. Therefore, we'll head into next week with that all-important, flexible, unbiased, and open mind, knowing that the hard data, the if-then rules, the risk-on, risk-off ratios, and the indicators, as well as the market model, will guide us if we're willing to listen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, Follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.